how do the Uniform Rules for Forfeiting, or URF 800, impact forfeiting transactions?
How does insurance serve as a risk mitigation technique in trade finance?
Why is it important to understand the different rights and obligations and the ability to negotiate or transfer between parties?
What are the fundamentals of trade finance and why is it important for global trade?
Perhaps you could tell us a bit more about the trends in electronic trade documents and the digital standards.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG.
Hi, and welcome to Trade Finance Talks. Today is a slightly different format than you're used to hearing. The TFG team is at the ITFA Educational Seminar hosted at A&O Sherman, and we'll be doing kind of a rapid-fire session with various different ITFA members. You'll be hearing from Lorna Pillow, Simon Cook, Sean Edwards, Sam Fowler-Holmes, Duarte Pedreira, Celia Cowlick, Paul Coles, and Pooya Jafari about everything under the vast umbrella topic that is trade finance. We're very excited about this educational podcast, and let's get straight to it. Today, I'm here with Lorna Pillow from ITFA, and first off, Lorna, thank you very much for joining us, and can you give us a quick introduction?
Thanks to the whole TFG team. Obviously, as a voluntary association, we rely on our partners to help us achieve our goals. I've served on the board for the past 9 years, and I'm delighted to see the way the association has grown and flourished on so many levels. ITFA is actually one of my favorite hobbies, where I get to share my motivation and passion in this very unique industry, together with many talented and amazing trade professionals. My full-time role is with LFC, delighted that it's our 4th year's anniversary. I haven't been that long, by the way, and blessed once again to work with such a professional, experienced team as COO of the company.
Let's dive straight into the questions here. What is modern forfeiting, and how does it differ from traditional financing?
Forfeiting is a technique for discounting receivables, typically using negotiable instruments such as promissory note and bills of exchange. These instruments are usually discounted without recourse, meaning that the seller gets paid upfront and doesn't bear the risk of the borrower obligor defaulting at maturity. As invoice receivables gained popularity, forfeiting, due to the cumbersome process of sending instruments from one country to the other, especially involving emerging market countries, lost popularity. However, the very specific characteristics of the techniques, mainly that the payment obligation is abstract from the underlying transaction, is the reason why we continue to look at forfeiting and obviously see the value that it adds when discounting transactions, as it also reduces fraud and disputes. In the last few years, mainly through the evolution of digitalisation, we have seen growing interest in the technique, enabling the creation, the assignment and transfer of such instruments in mere minutes. More countries are embracing digitalisation. We've seen the UK enacting the Electronic Trade Documents Bill, and last month, we've seen France following suit. The primary distinction between with or without recourse is that on the first, the discounting bank retains the right to claim the funds from the seller at maturity if the buyer does not pay. Financing on a without recourse basis is when the bank is taking the full risk of the buyer defaulting, i.e. has no claim against the seller unless there is fraud, as we will refer to in URF 800.
Short, concise, but very insightful, so thank you very much. And the next one, I'm going to dive a little bit deeper, and so I want to ask you, how do the Uniform Rules for Forfeiting, or URF 800, impact forfeiting transactions?
As you know, in 5 minutes, I will be giving the presentation on URF and URTPO. And way back when I started looking at URF 800, I wasn't quite sure why the rules were needed. We knew what forfeiting was all about. We knew how to discount these transactions. However, it should be noted that forfeiting transactions are not automatically governed by URF 800, so very similar to letters of credit. The agreement between the two parties must explicitly state that, same as UCP, that URF 800 offers the framework for the transaction. Importantly to note that URF 800 deals with the rules for the sale of the instruments rather than the validity of such instruments. Of particular importance is Article 13, and I will be explaining to our audience at the educational seminar why this rule is so important, because it removes the ambiguity as to the responsibilities that a party has towards each other, while clearly establishing that the risk of fraud remains with the original seller. This is one of the main benefits of using the rules, apart from creating timeframes and expectations around the sale and purchase.
You touched on this in your last answer, but I would love if you could kind of follow up on this. So what are the uniform rules for transferable electronic payment obligations, or better known as URTPO?
So like URF 800, URTPO, or the Uniform Rules for Transferable Electronic Payment Obligation, is a set of guidelines that was published by ITFA in 2022. In anticipation of the progress that was being made in MLETER, the UK Trade Electronic Bill, in ensuring that digital instruments are on the same legal footing as their paper equivalent. These rules aim to provide a framework for the transfer of existing electronic payment obligations, supporting the financing of international trade. The rules should be seen as a progression from URF 800. The framework, in fact, will coexist with URF 800. They are not replacing URF 800, as URF addresses paper-based instruments, while URTPO tackles the sale of electronic payment obligations. Although for this first version, we assume that some of the documents will still be in paper documents, because even if the bill is in electronic format, given where we are in trade finance at the moment, we will probably have invoices and bills of lading which are going to be in paper-based. The rules are technology neutral, aligned with the principles of latest legislation, and we will continue to follow progress here so that we can update these rules accordingly, and we encourage everyone who's involved with ITFA to continue following progress and to come to us with any suggestions.
Thank you very much, and I'll hand over the interviews to Kiki now for during the ITFA educational seminar series that we're doing here at TFG.
Thanks.
Hello and welcome to Trade Finance Talks. Today I'll be discussing trade finance structures and security with Simon Cook at ITFA. So Simon, quick introduction. Who are you and what do you do for all of our listeners out there?
Thanks very much. My background has been in the commodity and trade finance sector for the last 25 years, based both in London and in the Middle East. Currently, my role with ITFA is threefold. I'm also not only just on the executive board, I'm also a member of the Africa Regional Committee and the head of the education sector for ITFA itself. That's really why we're here today talking about in this podcast.
Thank you, Simon. So first question then. When structuring transactions, could you talk through the risk analysis that comes with it?
One of the benefits of structured trade transactions is the ability to deal with the various risks inherent in transactions. That allows borrowers to get better pricing and allows the funders to have a better risk profile for their transactions and hopefully get some capital relief. So what we do is, when you're looking at the risk question, essentially, the first thing you have to do really is identify what the risks are, and every transaction will have a different risk profile with different issues arising. And it's tried to work out what those are. So you're looking at what I call the 4 Ws, which is the who, what, where, and when. And here we're looking at the different stages in a transaction from the point in time when the funding goes in until repayment occurs. And all of the different stages in between, whether there might be shipping, there might be land transportation, warehouse storage, all that sort of thing. And obviously, the more complicated the transaction is, the more parties there are likely to be involved. And they can have either a positive or a negative impact on the risk profile of a transaction. And again, you're looking at what those parties are doing. When does the title to the product, the commodity, pass from one person to another? Who actually is the owner of the commodity at any given time? So you can work out what you need those parties to do at the different stages in the cycle, because you have to look for what might go wrong. And that could be everything from fraud to ship sinking with goods on board, warehouse fire, lots of different things that can go wrong. So it's working out what those risks are first. You've got to evaluate the significance of that risk and also the likelihood of it arising. For example, if you've got payment risk on a buyer or a group of buyers, obviously the significance of one buyer going insolvent is going to be much less if you have 10 buyers than if you only have 1 or 2 buyers. So the significance is reduced. Likewise, if you only have 1 or 2, it might be increased. You then need to look at, well, what's the likelihood? Because that's fine. If you've got 1 or 2 buyers, then it would be a significant issue. But if those buyers are Trafigura or Cargill or the big traders, then it's much less likely to happen than it will be perhaps with some lesser known traders who may have cash flow issues, that sort of thing, which you don't know about behind the scenes. You've got to look at that. and try and work out what the significance is of each deal. Once you've done that, you can then work out how to mitigate them or how to deal with them. And you can do that in a number of ways. So you can eliminate the risk. For example, if you're worried about buyer payments, you can get a letter of credit. If you're worried about a supplier not being paid by the borrower when they get the money from the funder, you can make the payment direct under the drawdown. So you can get rid of some risks. Some you can reduce by monitoring and having the right covenants in place to keep one step ahead of the game. Or you can do things like taking security to maximize your recoveries, control the goods more, make sure that they're always in your possession or somebody acting on your behalf. And then finally, you could allocate risk to other parties, such as insurers, hedge providers, if you're looking at pricing risk or interest rate risks. And as I said earlier, you could do letters of credit for the receivables. So that's really what we do when we're looking at the risks on a transaction and how best to deal with them in order to get the best structure.
Perfect. I think that's really helpful for all of us out there. So with that, I suppose we move on to our final question. What are the different structures in structured trade and commodity finance?
The main ones historically for this, and this is, I wouldn't say a narrow part, but it's not all of trade finance. It's a very wide set of products. But in terms of the structured trade and commodity finance ones, the most common ones are pre-export financing, advance payment financing, or sometimes called prepayment financing, and tolling transactions. And they've always been the bedrock of these structured transactions. In terms of what constitutes them, the pre-export finance structure is effectively a bank lending onshore to a borrower who's going to produce goods. So at the outset, the goods don't exist, so they're not financing finished products. They're financing something to go out, buy the raw materials, pay the production costs, and export. There's relatively limited buyer risk because the buyers tend to be offshore, but you do have things like country risk on the export, and you obviously have performance risk on the exporter. Do they have the staffing, the expertise? Are there going to be strikes? Have they got a track record of performance? Because this structure is not about credit risk. This structure is all about performance risk on the borrower who's the producer. Can they produce the goods and get them to the buyers? The credit risk on the buyers is usually the easier end of the spectrum in this sort of structure. You then have the advance payment structure, which is very similar. The main difference being is that instead of lending the money direct into the onshore producer, you're lending it via an off-taker, their first off-taker. So, for example, if you have a small coffee producer somewhere and they want to go and sell to their normal buyer, if that buyer is someone like, I don't know, Cargill or Glencore or whoever, the funder will make the loan to the offshore trader, will then use the funds to buy the goods by making an advance payment. Then when the production comes out, that off-taker will on-sell to its normal buyers, Cargill's end buyers. In between time, what you've got is essentially advance payment going from the big trader into the producer. If the goods are produced and delivered to the offshore trader, that reduces the amount of the advance payment and satisfies their obligations. If they don't deliver, they have to either pay the advance payment back or find some other way of funding the actual borrower. In terms of the funder's role with the off-taker, who's the borrower, that's a limited recourse facility in almost all cases, which means that the funder's borrower is only liable to the funder to the extent that they receive the advance payment back or they receive product. If they never receive anything back, they have no liability to the funder. Sometimes they do like a 10%, 90-10 split. Most often there's no liability going back, and the funder has to rely on the security it has, which includes security over the advance payment obligation and the delivery obligation from the producer in order to get repaid. So usually this comes about when the funder doesn't have a line in to that country or to that particular borrower. So they take advantage of the trader's relationship and get involved. The trader does like to control things a little bit more though, so there is a little bit of a compromise in how the structure and the documentation will play out in practice. The final one is called a tolling structure, which could be either of the above. The first two. The different element is that there's normally the need to process the raw materials into a product, but the producer doesn't do that. It has to go to a third party to do that, which raises issues around if you have security, how you take that security, because you no longer have the owner of the goods in possession of the goods. You've got the third party who will probably have a lien over the goods for their fees. It creates a more complex structure with more parties involved, which just means more risks to analyse and deal with.
Thank you so much. I think that's really helpful and useful to our listeners out there. So Simon, thank you for joining us today on Trade Finance Talks. And over to you, Jord. Thank you.
Thank you, Kiki. And today I'm joined by Sean Edwards. Sean, this is by no means your first interview on TFG, but perhaps for those that aren't familiar with yourself, could you give us a quick introduction?
Yeah, I hope it won't be my last either. So thank you for having me. My day job is as head of legal at Sumitomo Mitsui Banking Corporation for EMEA. I also have another sort of more commercial role within the bank advising our trade finance department. And lastly, I also non-exec on a Swiss fintech, Congo.
Thank you, Sean. So first off, could you maybe tell us what is supply chain finance and how does it benefit businesses?
Supply chain finance is one of those words that's very misunderstood because it's got a narrow meaning and a broad meaning. So let's start with the broad meaning. And supply chain finance is really any technique for financing that you use to improve corporate liquidity, to improve your cash flow. It's not directly about importing and exporting goods. It's more about how you finance your sales of those. And there's a number of different techniques for doing that. Forfeiting obviously is where we come from as an association. Factoring obviously is very widely used. Distribution finance. There's a variety of trade-based corporate finance techniques as well, where the trade flow will be used effectively as security for what is corporate lending, essentially. But then you have supply chain finance in its narrower sense. And that's what most people think of, supply chain finance. That's what a lot of people call reverse factoring, or what we like to call payables finance. The trade associations got together a few years ago and they produced something called the standard definitions for techniques of supply chain finance. It's a bit of a mouthful. We should have come up with a snappier title, but it covers all of those. But supply chain finance is what a lot of people think of as reverse factoring. And essentially what that allows the suppliers to do is to access finance based on the creditworthiness of the buyer. So in fact, the buyer will set up these programs. It will go to a bank and say, if you agree to supply these, agree to pay, and it could be early pay or on maturity, these suppliers, I agree to pay you. I give you an absolute obligation that I will pay you on the due date. And there can be an extension of financing terms, so the date, the tenor of that. So it might have been a 30-day invoice. The bank will give the buyer 60 days. We'll come onto that in a minute about why that has been problematic recently. But that essentially is what payables finance, reverse factoring, what a lot of people call supply chain finance, that's essentially what it is, what it does. It's a win-win situation for buyer and seller.
Thank you, Sean. That was a very good introduction and summary of supply chain finance. So moving on, what are the current issues faced in supply chain finance and what are maybe the big opportunities?
Recently, what we've seen in the recent Demica survey, which I recommend everyone to read because it's the most sort of up-to-date survey on supply chain finance, actually we found, and this is largely because of where interest rates are and corporate liquidity, there's been a little bit of a tailing off in payables finance, the reverse factoring, the supply chain finance in a narrow sense, and a bit more on the receivables finance. That's been more attractive recently. We're looking at payables finance or reverse factoring. Two big issues have come up, both of which I think we've headed off at the pass. The first one is, I mentioned earlier that it's quite important to be able to extend payment terms for the buyers, and that's where banks, of course, find the opportunity. That's where their money essentially. In Europe, at least, and there are echoes of this throughout the world, we have the late payment regulation that was introduced as a draft and has been debated in Europe, in the European Parliament, in the Council. And what that is seeking to do is to put an absolute lid of 30 days on payment terms. So you can't extend beyond 30 days. So, in typical payables finance, what was going on was that the invoice would move from 30 to 60 days, but the seller would be able to discount at an earlier date. So he would get his money when he wanted to. The buyer got this extension in payment terms. And of course, there was an impact on the economics, but that was usually worked out. If you put a lid on the number of days an invoice can be outstanding for, you've obviously reduced the opportunity for banks to extend payment terms and do funky stuff. That was introduced last year in the EU as part of their small SME initiative. It's met with a lot of resistance. Of course, we recently had the European elections. The person in charge of the late payment regulation was not re-elected. There's been a lot of resistance to it from the member states. So we think that will not happen, at least in its current form. And we'll be able to extend and we'll be able to be creative. And it's really important, as we've said to the EU as part of our outreach, it's really important that banks can inject liquidity into the supply chain. That makes it resilient. And resilience of supply chains is what's absolutely critical at the moment with everything that's going on in the world. The other thing that is happening, and it's been happening for a while, so we're sort of beginning to see the effects of it, and those are the accounting changes. So both the US and essentially the rest of the world accounting standards boards have produced rules for supply chain finance. That was in response to concerns by rating agencies that they didn't have enough information about supply chain programs within corporates' financing stacks. They weren't able to analyze effectively their position properly. For both the US and the rest of the world has come into effect this year. Effectively, it's the first accounting period So we don't know exactly what it's going to do. There have been some doomsayers who've said it's actually going to cut off the supply chain finance by banks. We don't see that at the moment. We don't see it really as affecting what the corporates are having to do is to be more transparent about it. And I think there are probably some sort of fringe players that might get knocked out, but essentially it hasn't affected it. As I say, we're in the first year, so we don't know yet 100%, but it looks like that's okay. So there's two big swords that we managed to avoid. Those are the two big issues. There's a lot more tech, of course, going into this. In ITFA, we started looking at deep tier supply chain finance, where you look at extending the finance not just to the first supplier, so the supplier who's got a relationship with the buyer, but suppliers of the supplier of the supplier, and so on. And in theory, you can go all the way down. Practice is going to be. That needs a lot of technology to make it work. It's been difficult. Asian Development Bank have been looking at that for a while because they have a lot of SMEs, obviously, out in Asia with a few big sellers. We have the relationship with the buyers. Let's try and push that finance down the chain. That, I hope, will happen. It will take time. So some real opportunities there. And I say if you look at supply chain finance in the big sense, if you include then the receivables purchasing, as I said, that's been going up recently because of interest rates. It's a very dynamic area. There's a lot going on. A few dangers that we've headed off, but still a lot of opportunities, and it's a very exciting space to be in.
Thank you, Sean. As always, it's a pleasure to have your expertise on TFG. That was Sean Edwards at ITFA, and now over to you, Sylvia.
Thank you, Jude. Sam, could you tell our viewers a bit about who you are and your background?
I specialise in trade, commodity and export finance.
Thank you. First question, can you explain what the most popular types of trade finance instruments are and how they work?
There are a number of different types of trade instruments that we see being regularly used. I think first and foremost we have letters of credit, so that's documentary letters of credit and standby letters of credit, and we also have demand guarantees. And those three are very much embody a payment obligation on behalf typically of a bank in favour of a beneficiary in an underlying commercial transaction. And the idea is that provides some certainty for the beneficiary of getting payment if a particular set of circumstances exist. So if the transaction proceeds as it should do, or occasionally it can be to support if the transaction doesn't work it was intended to.
That's really helpful, thank you. Can you tell us a bit about how the ICC rules apply to these instruments?
There's probably three sets of ICC rules. I mean, there are many, but for these particular instruments, we have uniforms, customs and practice, which were developed specifically for documentary letters of credit. We have international standby practices, or ISP 98, which were developed for SBLCs, uniform rules for demand guarantees, URDG 758. And the purpose of these is to provide some harmonization and sort of industry standards that users of these instruments can incorporate into those instruments to set out as standard rules so that we can ensure that from instrument to instrument, transaction to transaction, that we have some standardization in what is a global industry in a global market.
Last question. Why is it important to understand the different rights and obligations and the ability to negotiate or transfer between parties?
Any contract, and these are just contracts, it's really important to understand, what rights you have as a party in that, under that instrument, and what obligations you have. And this is even more so, coming out of the pandemic, we saw a global crisis of the scale that we hadn't seen before. The world shut down, trade shut down, and suddenly you had entities with rights and obligations under these instruments being in a very different position to those that they expected to be in. And interestingly, we found, in terms of your question about the rules, people realizing that depending on which rules you'd incorporated, you could be in a very different position under your instrument than if you'd incorporated a different set of rules that you might have used. Be the lawyer in me, but I'd always say it's really important to understand what your rights are and what your obligations are for any instrument.
Thank you for joining us at Trade Finance Talks today. Over to you, Nikhil.
Thank you, Sylvia. And today we are joined by Duarte Pedreira. Duarte, thank you for joining us, and please could you give us a quick introduction about yourself?
Thank you, Nikhil. Absolute pleasure. I do multiple things, kind of the daytime jobs as Global Head of Trade Finance for Crown Agents Bank. I am also a board member of the ITFA, the Global Trade Finance Industry Body, which comes with a significant time span. I lead institutional relations, which then means that I lead the development financial institutions stream of the industry. I'm also heading up what we call the emerging leaders. I'm the founding chairman of the Africa Regional Committee, and I'm also a lecturer on behalf of ITFA, the Bayes Business School. And I do a few other things, but probably we stick to these just as a taster.
Thank you for that introduction. What are the fundamentals of trade finance and why is it important for global trade?
Fundamentals of trade finance are very clear. I mean, trade finance exists to bridge the gap that exists between importers and exporters. An importer will always want to pay as late as possible and receive the goods as quickly as possible. And an exporter will always want to get paid in advance and ship the goods later. That's because there are a lot of risks sitting between importers and exporters. You can think about country risks, sovereign risks, political risk as it's known, of course commercial risks to the default of either the exporter or the importer, or both in a catastrophic event, currency risks, business risks, and so on and so forth. So as I normally tell my students, it's a little bit of a standoff, isn't it, between importers and exporters. If you think about two people in a duel in the good old Wild West, who's going to shoot first? Is it the importer who will agree to pay and receive the goods later, or is it the exporter who will kind of concede and send the goods first and wait for payment later? So bankers are not all bad. We do quite good things, particularly around facilitating international trade. And I think that can never be understated in terms of the importance we have in allowing different countries, different counterparts to trade with one another. And why is that? Well, it's very simple. Because we are the ones who then agree to take on these risks from importers and exporters, and not just do the risk transfer and effectively take it in our books, but also to provide funding against that risk. So an exporter will need some sort of funding at the outset to prepare and deliver the exported goods, and the importer normally requires funding to extend his cash flow. That's why we exist. That's why trade finance is there.
Thank you for that breakdown and explanation, Duarte. Why are standard contracts important for trade finance and common terms and standards?
Risks themselves are an antonym of certainty. The more certainty we can add in a trading relationship between two different counterparts, be it an importer and exporter in the financial sector, facilitating those imports and exports, the more certainty we add to the equation, and the more we reverse that risk aversion. So I do believe that standardization is an important component of what we do, creating a level playing field, clearly identifiable roadmaps, and that's a big task for ITFA as the global trade finance industry body, is to create an infrastructure that people and users in particular trust, and standardization is a big part of that.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it.
Thank you for joining us today on Trade Finance Talks. I'm sure our listeners found that very informative. Next is over to Kiki.
Thank you, Nikhil. Today, I'll be discussing insurance with Celia Kalak at ITFA. So, Celia, quick introduction. Who are you and what do you do?
I have been working in different banks, in different countries, and also I have been an insurance underwriter. Presently, I'm responsible for supply chain and finance and documentary trade finance distribution at Banco Santander. I have a great passion for our business because I believe that it can help development and progress all over the world. ITFA plays a very important role to improve the business environment through education and advocacy. And that is why I engage with ITFA and then try to bring in my expertise.
That's perfect. Thank you so much. So first question then, how does insurance serve as a risk mitigation technique in trade finance?
Credit insurance is used as a risk mitigation to provide protection against political, commercial risk and credit default. It is used by private and public companies. Banks use it mainly as a tool for risk mitigation in transaction banking by using 4 different forms of insurance. The first one will be single risk non-payment insurance. Then we have whole turnover trade credit insurance, and we have surety protection for guarantee and bond portfolios. And the fourth option is actually that insurers also offer sometimes cover for trade finance under risk participation agreements. In 2023, ITFA conducted a survey together with IACPM globally on credit protection and with 44 banks who participated. The most important result from this survey was that credit insurance is growing. And between 2021 to 2022, it grew by 20%. And the total insured exposure is now 166 billion, leading to facilitated transaction over 360 billion.
Thank you. That's really helpful. Could you discuss perhaps why trade credit insurance is used for capital relief migration?
The survey, which I just mentioned, showed that 30% of the banks use trade credit insurance for credit risk mitigation, while 70% use it for capital relief. Credit risk insurance is, as per the European regulation, the CRR or CRD4, a tool which is accepted to reduce credit risk and risk-weighted assets. Why do banks use specifically? You can also use bank syndication or other forms of protection mitigation. And why do banks like to use insurance? Because normally banks and insurers do not compete. And insurance is silent. Nobody knows that you have this insurance besides you and the insurer. And that can make you look having more capacity. For instance, in a syndicated a facility where you want to be a lead arranger and you need to have a minimum amount, for which you maybe have not the capacity on your own balance sheet. You can have insurance and by that increase your pad. On the other hand side, insurers like to cover banks because they value that they have an educated partner who knows his business and who can do an in-depth credit analysis, and they can rely on that. They also get access to additional business, which they could not do directly, because an insurer cannot do supply chain finance or cannot issue a documentary letter of credit. And it helps insurers to diversify their portfolio. That is crucial for insurers.
Perfect. And with that then, I think that leads me on quite nicely to the next question, which is the final question. What are the current issues and techniques in trade finance insurance?
I just mentioned that the European regulation, CRR, which is based on the Basel framework, allows for capital risk reduction. However, this regulation is presently renewed. There is this so-called Basel IV or the Basel III renewed, which is implemented presently in Europe in the CRR, in the Capital Requirements Regulation. There is a main challenge, which is that from beginning of next year, your insurance cover will have to be evaluated in the foundation approach for the LGD, the loss given default. Now, the loss given default says in case of your risk defaulting, what is the amount which you can recover? Now, this LGD has been set at 45%, so very high for insurers. That means you cannot recover much when in case of an insurance defaults. This makes total sense in case you are lending money to an insurer, because of course an insurer has a lot of preferred lenders, and therefore when an insurer defaults, you have lent money to the insurer, there will be not much to recover. However, who are these preferred lenders? The preferred lenders are the insured. That is why we say it is not fair that when you are an insurance policy holder and you have this position of the preferred lender, that you should have such an unfavorable LGD treatment. Also, this would put a question mark to many of these contracts which we are holding at the moment, because they would not be efficient anymore for capital reduction. Because the corporate standard LGD is only 40% and can be even lower if you model it in the advanced approach. We have been talking a lot to the European Parliament, to the Commission, to the European Banking Association, the EBA. We have discussed with them. We have explained what we do. We have provided lots of statistics. And the result is that in the new CRR, we have Article 506, which says that the European Banking Association has to re-evaluate this 45% in case you are an insurance taker. And also for the first time, insurance was expressly mentioned in the CRR. So this is, I think, ITFA has already done a very hard work, and we hope to come to some success to lower this LGD for the beginning of next year for the implementation of the new CRR.
Yes, definitely. That sounds great. Celia, thank you so much for joining us today on Trade Finance Talks. It was a pleasure to host you. And over to Brian.
Great, thank you very much, Kiki. I'm here with Paul Coles now. So, Paul, could you please give a quick introduction?
Yeah, hi. I'm a Treasury Director at Orbion, managing the relationship with our funding partners, and I'm also an ITFA board member and the chair of the Market Practice Committee.
Let's jump straight into the questions now. So, what is risk distribution, and who distributes trade finance assets, and why is that important?
I I think for any large originator of trade finance assets, risk distribution is a key part of their toolkit, basically, because it allows them to do more, where they've got either a capital constraint or a credit risk constraint, or they're trying to manage their transactions where maybe the sole provider of a solution for a client, but on the other hand, they can't accommodate the full size of the transaction on their own. So it's a very useful tool to be able to then achieve more and keep doing more business where otherwise they'd have to turn down the customers.
Thank you for that concise but a very insightful comment there. Now let's go a bit deeper into the weeds in this area. So let's talk about risk participation agreements, which are linked to trade finance distribution overall. So can you talk us through what are master risk participation agreements and how they're used in the whole ecosystem of trade risk distribution?
Master participation agreements came about roughly in 2008 with the introduction of the BAFT NPA. And the reason for that was people were using very proprietary documents back in the day. Everyone had their own version. They were all very different from each other and therefore quite difficult to negotiate. There was a concerted effort by the industry to put in place an industry standard document that could be used by everyone to, again, try and remove the laborious process of negotiating these master documents. Over time, they were refined, and the purpose of those documents, they're bilateral. You put them in place. The master terms and conditions cover all the salient points, and then you just have a transactional offer and acceptance for each and every deal that you're then doing with that participant. And the beauty of that is you put the hard work in at the beginning for the master, and then the transactional side becomes a lot simpler and quicker to execute. And over time, the first documents, there was the BAFT 2008 under English law, quickly followed in 2010 by the New York law version for the Americas market. And over time, people then started using those documents, seeing where there might be gaps and improvements that could be made. So in 2018, a BAFT working group was put together using feedback from ITFA members, in fact, to refine those original master participation documents, bring them up to date, and that was the genesis for the 2018 English law and 2019 New York law. Just recently, earlier this year, we published the ITFA MARA, so Master Accounts Receivable Assignment Agreement, which was another initiative by ITFA to try and create a master agreement specifically for open account distribution, so covering supply chain finance and receivables finance.
Cool. Thank you very much. And everyone, that was Paul Coles. And Paul, thank you very much for joining us on Trade Finance Talks. Over to Nikhil now.
Thank you, Brian. We are back again with Sean Edwards. Sean, thank you again for joining us.
Pleasure.
How is the regulatory landscape evolving in terms of ESG?
Well, massively. I think it's probably the most active regulatory sector for good reason. There's good and bad in that. The good is, of course, that we have to deal with climate change and all the various aspects of net zero. And also, I think very importantly, we also have to really think about what the S and the G means. So a lot of focus on the E because it's more measurable scientifically, but the S and the G are really important for certain regions like Africa, for example, that emits very few carbon emissions, can't measure that, and therefore is a disadvantage. But where some of the things that are being done to some of the issues that are taking place have real positive S and G, especially S effects, but can be a little bit damaging on the E side. So it's really important to get a balanced view about what that means. But the regulators are extremely active in Europe. They're active, slightly less active in the UK, but also very active. There are already a couple of really interesting panels yesterday here as part of ITFA Week discussing how numerous regulators, including people like the Advertising Standards Authority here in the UK, are passing regulation or rules that impact banks and actually everyone's behaviour on ESG. So it's enormously active. The EU really is the leader here with the taxonomies and the directives that are beginning to come into force. It's a very confusing area for many.
What impact does ESG have on trade finance?
Massively. I mean, across the range. So supply chain finance has been very much in the crosshairs because the majority of Scope 3 emissions come, and they are the majority of emissions that are produced globally. So that is emissions produced in the supply chain, in a corporate supply chain, as opposed to emissions that they directly produce. So that's been very important for the supply chain finance industry, going sort of up upstream, as it were, in terms of financing, actually encouraging that through dedicated facilities, sustainability-linked loans, having use of proceeds language. Of course, green bonds been around for a while. There are dangers here around greenwashing, which have been in the news recently, but it's been massively important for the banks, both to encourage it and to your previous question, to meet the requirements of the regulators.
Thank you, Sean. Thank you for that insight on the ESG and how it plays a part in trade finance. Next up, it's over to Jord.
Thank you, Nikhil. And finally, we're joined by Puya Jafari of ITFA. So Puya, quickly, could you give us a short introduction, who you are and what you do?
Thank you very much for having me, John. My career to date has been focused on launching, implementing, and scaling new products and technologies, and I'm very lucky to be working closely with several of the most innovative and successful fintechs in our industry to design new products, market them jointly to our clients, and collaborate to drive change at the industry level as well. Outside of my day job, I work with the International Trade and Forfeiting Association, where I'm the chair of the ITFA Emerging Leaders, the global industry organization for early talent in the trade finance industry.
So first off, could you maybe tell us how are fintech platforms changing trade finance and risk distribution?
The role of fintech platforms in financial services is to improve the customer experience, help companies capture additional revenue, improve operational efficiency, and meet regulatory requirements. In the context of trade finance and risk distribution, that means addressing and overcoming some fundamental challenges. So for example, supply chain finance platforms or multi-bank platforms have vastly improved the customer experience for corporates looking to access financing from multiple sources in an efficient manner. These platforms have enabled a wide range of lenders to deliver supply chain finance by taking on much of the technical and operational burden of running the FCF programs. That was previously something only the most advanced trade finance banks could deliver because they were the ones with the IT budgets and operational resources internally to handle that kind of business. But today, smaller banks, institutional investors, private credit funds, and other non-bank lenders are all active players providing supply chain financing. We're even seeing financing embedded at the transactional level and offered by e-commerce and logistics operators. And as a result, there's been a shift in how corporates access financing, especially SMEs. When it comes to operational efficiency, traditional players also look to the technology providers for solutions. Let's take the problem of physical paper, for example. In the delivery of documentary trade instruments, reviewing and processing information provided on paper requires enormous resources from a bank's perspective, and that applies to PDF documents too, by the way. And while the trade industry is aiming to move away from paper altogether over time, banks are increasingly using optical character recognition software specifically built for trade finance to handle large volumes. So in simple terms, OCR extracts information from a paper source and converts the information into machine-readable data. And using that data, banks can deploy machine learning and AI to automate tasks and act on that information. And this is already being deployed by many trade banks who have significantly reduced processing times. Other technologies focus on client screening, fraud prevention, regulatory reporting, and so on. And what they all have in common is that the technologies are usually created by a third party, a platform company, and the traditional players in the trade finance ecosystem look to these third parties to collaborate to solve long-standing challenges. Where I expect to see even more rapid development and scale over the next few years is in the second trade finance market, where financial institutions buy and sell trade finance assets. For multiple reasons, including corporates requiring more liquidity and upcoming Basel IV regulations, a lot of banks are pursuing what we call an originate to distribute strategy. That has coincided with demand on the institutional investor side, where investors wish to include trade finance assets in their investment portfolios. And the role of fintechs here is to facilitate this expansion of the secondary market to help banks improve and automate workflows so they can handle those bigger volumes, and to help the banks transform previously illiquid trade finance instruments into assets that can be easily sold beyond the bank market. Specifically, that means removing paper, automate transaction and portfolio servicing, reporting, means repackaging assets into notes, and support banks with connecting with new investors. And the fintechs are also active at the industry level to promote standardization and education.
Thank you, Puya. I think that was a very good overview of how fintech platforms are changing trade finance and risk distribution. You touched on digital documents. Perhaps you could tell us a bit more about the trends in electronic trade documents and the digital standards?
Absolutely. Until very recently, we all lived in a world where certain trade documents, such as bills of lading, bills of exchange, and promissory notes, had to be in the form of a physical paper document. That was required by law for very specific reasons. You had to be able to possess the document. You had to be able to prove that there is only one original, that you hold that original, and you had to be able to transfer it to someone else.
However, in 2017, the United Nations Commission on International Trade Law published the Model Law on Electronic Transferable Records, providing a blueprint for how we could enable the legal use of electronic trade documents. And since then, a few key countries have enacted legislation within their own jurisdictions based on this MLETR model law. Notably, these countries include Singapore, Abu Dhabi Global Markets, and England and Wales in 2023, and France just last month in June 2024. Other countries are following, meaning there is a legal framework in place to start using electronic trade documents. There is a provision in the legislation that calls for software systems to be reliable. The questions of how we get comfortable with this requirement is still outstanding, so that's an area of focus for the industry right now. I think it's important for practitioners to understand that even though things are moving slowly when it comes to uptake and scale, everything has been moving in the right direction, and we have the law in place, we have the tech, and as an industry we're getting to work to ensure that this scales. And because this is aimed mostly at corporates, there are substantial efforts underway to educate the market on the opportunities electronic documents can unlock. ITFA's Digital Negotiable Instruments initiative has produced some helpful guides and materials, and they're offering workshops to market participants to explore these developments in detail. To ensure adoption, the biggest wins will come from identifying a real pain point for a corporate customer and using the tech to address that. I think we'll need to see some successful case studies to get more interest, and ideally these should be cross-border transactions. Further down the line, the major opportunity lies in combining digital trade documents with supply chain finance to get the security of these traditional trade finance instruments embedded in a lending product without adding cost and operational effort. As for digital standards, there's been so much good work produced in the last few years. So the ICC's Digital Standards Initiative, for example, published a set of data standards and recommendations after identifying 36 common trade documents used globally. Fintechs and software providers need to adopt the standards to make sure their solutions can be implemented at scale. It is a reality that the biggest actors in trade finance are demanding end-to-end digital workflows. So if a solution isn't interoperable with existing systems, it's unlikely they'll adopt the solution. Once again, I'll come back to the importance of awareness and adoption because we need the whole industry to be in tune on this. The ICC Centre for Digital Trade and Innovation in the UK is doing a lot of advocacy work, and we've already seen several interesting pilots as a result of that work. The key takeaway from my 2 cents here is that to get adoption at scale, we need market awareness, interoperability, and we need to bridge the gap between fintech platforms and the end users. I'm really optimistic on the legal and interoperability part because there's so much good industry involvement and commitment by all the relevant stakeholders, including regulatory authorities. When it comes to bridging the gap between product development and successful implementation, I think we're moving far too slowly. Most organizations either ignored or rushed that crucial stage between successful product design and successful implementation. And as a result, adoption has been very slow even when there are pressing needs for technology, and that technology exists. The real transformation in trade finance will be quite gradual. It's already happening, but I think we'll need to spend the next few years focusing on adoption of existing technologies rather than seeing the emergence of any new groundbreaking technologies. And that's not necessarily a bad thing because we have some really exciting tech that should keep us busy for a while.
Thank you, Puya. It was a pleasure to have you. That finally concludes our podcast series for today. I'd like to thank all of our guests for joining us, and I'd like to thank ITFA for the educational seminar and A&O Sherman for hosting. As always, thank you to all of our listeners, and we'll see you next time.